little bit from the accounting to very basic finance concepts. And these I feel are very important for every interview, irrespective of your background. And the first is time value of money. I think all of us have heard of something called time is money. I think we use it in our daily lives, and we probably have people telling us time is money. And trust me, this is actually true, because $1,000 today is much more than $1,000 5 years later. And that is essentially because the time lapse between these 5 years leads to a deterioration in value of money. So whenever you look at any sort of an investment proposal and they tell you, okay, invest 10,000 rupees today and we will pay you 1 lakh rupees after 10 years at maturity, how do you decide that investing this 10,000 today is worth that 1 lakh that you're going to get after 10 years? You simply calculate time value of money. And what is time value of money? You calculate the present value of all your future earnings and compare it with the 10,000. If you are getting more than the 10,000 that you invested, yes, it's possibly something that you should look at. If, of course, you're getting less than 10,000, the investment is a non-starter. How do you take out this present value? It's nothing. It's just dividing your future returns by a discounting rate. This discounting rate can be any rate of return that you are looking to generate. You want that your money should give you a return of 10%, your discounting factor is 10%. You think you're someone who's safe, who says, okay, even if I'm getting a bank fixed deposit rate, I'm happy. You probably look at a 5-6%. It's absolutely simple. You just divide the future cash flow that's going to come in with the discounting factor and take out the present value. If your present value of inflow is higher than outflow, invest. If your outflow is higher, inflow is lower, don't invest. Two elements. One is a net present value. One is an internal rate of return. Always go with the net present value and never the IRR because of the following reasons. IRR assumes that the money that you're coming in is getting periodically reinvested, and you will always have to use a single rate, and NPV gives you an opportunity to use various rates. I hope this was not complicated. If complicated, I can repeat.
Yeah, ma'am, can you repeat?
Ma'am, please repeat.
Yeah. Okay. So you get a call from this person who says, invest 10,000 rupees today. After a year, I will pay you 12,000. When you look at this problem, you feel, oh, I'm going to get 2,000 rupees, so why should I not invest? But the question that you have to answer before taking the plunge is that 12,000? If suppose I was to get that 12,000 today, what would be the value of this 12,000? So I'm starting with year 0. I'm going to year 1. And I'm comparing this year 1 inflow to my year 0 outflow. Do you want me to do this over an Excel or something? If this is...
Yeah, if possible.
1 second, yeah. I kind of understood with the silence that it's not working. Yeah, no worries. But this is important, so I would urge everyone, if you have any sort of doubts, please clear them right now. There are more doubts, we can do it offline. So, I have a year 0 and I have a year 1. Okay. Now, I am being told that you invest 10,000 at the beginning of the year and you will be paid 12,000 at the end of the year. So far, so good?
Yes.
Now, When you look at this, you feel that you're going to get 2000 rupees. So why not do it? It's a good investment. However, you have to decide what is the value of this 12,000 today. Today meaning year zero. Suppose you are looking at a rate of return of, I'm just taking a number, 10%. So what I'm going to do is I'm going to divide 12,000 by 0.1, which is 10%. So when I
Yes.
divide it by 1.1, I'm getting a value of 10,909. So this means that on this investment, I'm going to earn an actual return of 900 rupees. Hence, I should invest. So my NPV, which is net present value, is this minus this, which gives me a positive number. If this is positive, the investment is worth investing. If this is not positive, it's not worth investing. Clear now?
Hi, actually, I have one small doubt.
Hmm.
Uh, so this rate of return 10% is basically what is it subjective to us, what we
Oh, yes.
want as a
Oh,
thing.
absolutely, yes. If you are someone who wants a higher return on money, you change this return. Let's say I
Okay.
want a 20% return.
And so one more small, just technical doubt. So for example, when we generally speak in a common language and we say, ki, what is the value of 10,000 rupees after 10 years? So
Hmm.
that time the rate of return is actually the inflation we're talking about.
So it's typically the inflation. It may or may not be. Again, this is your basis of how you look at it. But yes, when you read it in newspapers, and the general industry view is to multiply it by the rate of inflation.
Got it. Got it. Thank you.
Ma'am, I understood what NPV is, but I
Hmm.
don't know what's the definition of IRR here.
So internal rate of return is nothing but this 10%,
Okay. Okay, got it.
because that is the rate or the percentage at which my outflows is equaling my inflows.
Got it.
And ma'am, one more thing, you just said that in NPV there can be more than one rate of return. So
Correct.
how will we take that into account, ma'am? Can you?
So when you have multiple returns, like for example, you have a year one, year two, year three, and you may want to discount it at different rates, then you can take multiple rates as the denominator. So yeah, then you can take multiple rates as a denominator and discount your cash flows basis those rates and come up with one present value.
And ma'am, we have to decide this particular rate of return ourselves, like on what parameters, or is there a particular formula for it? Like how do we have to get to that R?
So you take a lot of thumb rules, you take a lot of industry benchmarks. Like for example, if you're someone who is conservative, then you probably take the bank interest rate. Whatever the bank is paying, if that is good, if that is what your money is earning, then possibly that rate works for you. If you are in a business where you have to borrow money and that borrowing cost is, let's say, 8%, so any venture that I get into, I will want to earn more than 8%, right?
Yep. ma'am.
So then my rate becomes accordingly. If my cost of borrowing is, let's say, 10%, then I will want an investment which has an 11% return minimum. So whatever
Okay.
your cost of generating that resource or that source of fund is, typically your rate of return is determined by that factor.
Got it. Got it. And one more thing that like if we are to calculate like after 4 years, like there will be four particular segmentations, right? That first year, second year, third year, fourth year. So like we have to calculate directly the value of the money after 4 years to the present value, or
Yeah.
subsequently for the third year, second year.
So what you do is that I did it for 1 year. So I did it 1.1. Suppose now you have something for 4, so you do 1.1 to the power 4. So you go directly from year 4 to year 0.
Okay. Okay.
You don't have to bring it to 3, then 2 and 1.
Mm-hmm.
And Excel has an absolutely easy formula. You just have to do equal PV, plug in your numbers, and it will give you the present value.
Got it. Got it. Thank you.
And so that's not a problem at all. So now, assuming that this time value of money concept is clear, I'm now going to take it a notch higher. And this is called valuation of a company. So we've all heard of these absolute extensive valuations that companies earn, and they get money on that basis. Someone buys, people, you have these startups becoming 1 billion valuations, they become unicorns. Companies have XYZ valuations, people are giving them money, they're investing, they have these series of funding. Valuation of a company is nothing but the present value of all its future cash flows. It's absolutely that simple. I will have a projection that I expect my company to earn X, X1, X2, X3, X4. The present value of this X, X1, X2, X3, X4 today is Y, and Y is my valuation of the company. Make sense?
So, ma'am, what is the time frame we are looking at? I mean, what is the future? This future talking about how many years is this future into?
Yeah, so there are two things there. You usually do projections for 5 to 7 years in a fast evolving industry. For a stable industry, you do 10 years, and then you take something as a terminal value. कि beyond 10 years, हम एक steady growth rate ले लेते हैं, which is typically the rate of inflation, and एक X total value निकाल लेते हैं कि beyond 10 years ये value है, 10 years की ये value है, join these two and you get the valuation of the company. Okay. Years is playable. If you feel that you cannot predict the future beyond 5, take a projection for 5 years. You feel the industry is stable, the industry doesn't have a lot of technological evolution, probably take 10 years. Okay, so years is playable.
Right, so this thing again becomes something very subjective again to the person who's evaluating it.
Oh,
there is no standard procedures for this.
So yeah, so please understand, okay, I will repeat this again and reiterate this even going for future. Projections are nothing but accounting estimates, and they will differ from person to person. They are nothing but accounting estimates. Yes, they may be based on a trend. कि हाँ 3 साल में कंपनी ने 10% ग्रोथ दिया है तो आगे जाके भी देगी, but it is just an estimate that I am making. So as an investment advisor, and this is what the investment bankers do, you would have heard of a lot of these IPOs, and people have these lead bankers, people who help you with getting these valuations and stuff. It is absolutely subjective. I feel that, for example, I feel pharma is a sunrise sector. So I'll value the company much higher because I believe that the future of the company is very bright. You probably wouldn't. And both of us are not wrong. That's the beauty of valuations. No one in this game is wrong. Until, of course, the time comes and you are proven otherwise.
Then, ma'am, whose opinion is valid, counted? Someone is saying the company is
an expert at it. Someone who's done it time and again and has a history of successes. For example, today I will tell you guys, the Tata Motors share is trading at 540. I feel 540 में खरीद लेना चाहिए because मुझे लगता है, basis some calculation, I can share Excel sheets on it, that this company's share price is going to become 5,000 in 10 years. Will you listen to me? Who am I? Probably no one. However, if today we are having this session, let's say with Warren Buffett, and he tells you this, will you buy? Yes, you will, because time and again he's proven his expertise. And similarly, you go for people or you go for these banks who do this day in and day out and hence have more expertise than general people and are able to make more accurate estimates and projections. Again, at the end of the day, it's a projection only. But how accurate or how closer you are to the number, that's what matters. Sounds good?
Yeah, like someone says that the company has become unicorn, means it has
Correct.
crossed $1 billion valuation. So it may be,
Yes.
like countered that no, you are wrong.
Absolutely, absolutely. And there is no guarantee that these companies who are today unicorns and have a 1 billion valuation, they may not achieve those estimates which have been touted. For example, let's say if just throwing an absolute number, please don't take the numbers on value. If today, let's say Zomato is earning 100 rupees, and my estimates for FY 26 or 27 is they're going to start earning 1,000. And basis that, I have taken out a valuation of X. Probably in financial year 26, 27, they will not be earning 1,000. They may be earning 800 or they may be earning 1,200. Because I don't know what's going to be there. However, I have an estimate because I understand the industry. I understand which environment is the company surviving in. I have a sense of the future outlook. I have understood the company's fundamental basics, and hence I believe that the fifth year 1,000 revenue is doable. So far, making sense?
So, ma'am, one thing I just wanted to ask you. So, basically, for a particular startup, when we say the valuation is 1 billion or something, it's based on the previous, like the fund that it has received, right?
No.
No. Okay.
You receive funds basis valuation.
Yeah, but when we hear that, okay, this particular startup is now a unicorn, it means that the valuation right before it, which was done, I mean, the latest investment that the particular startup
No.
got is valued.
When I say that this startup has turned a unicorn, it's currently having a valuation of greater than $1 billion. All I'm saying is that the present value of all future cash flows of this startup is $1 billion.
So, but when I read it, am I getting an input from somebody who is like an authentic source? I mean, does some particular source give this particular startup a unicorn tag? It will.
No, so what? No, okay. So what happens is that when you are going for funding, you do these projections. You do a set of internal estimates because you understand the company.
Okay.
You get a set of external estimates. There is some banker who works with you very closely, helps you get these numbers much more in order. You present it to your investor. Okay, so this is, I believe, the trajectory that my company is going to see. If he or she buys into your trajectory, they invest at a certain valuation for an X percentage of your equity.
Yeah.
So all I'm saying is I am not earning. Please, and I'm going to repeat, I am not earning $1 billion. All I'm saying is I am slated, or I'm expecting that by the next 5 years, this is going to be my revenue and this is going to be how the company is. Hence, today the present value of my company is $1 billion.
Yeah.
Ma'am, Shantika this side.
Yeah.
Ma'am, I have a very basic doubt. When
No
you
worries.
say when you say the term venture capitalist private equity, ma'am, what
Mhm.
is this exactly?
Yeah. Okay. Very similar entities, but slight difference. So what happens today is, so earlier, okay, I'm going to give you a little brief history, then come to this. So a company, in order to do business, has typically two sources. One is I take debt, मैं बैंक के पास जाऊं, बैंक से लोन लूं, या मैं लोगों के पास जाऊं, लोगों से पैसे लूं. When I go through the second route, पहले क्या होता था? There were companies who would do 10 people come together, form a company. 10 people put in money. That was their invested capital. Now this company needs more money. So they go for an initial public offering where they go to the stock market, list the company on the stock exchange, people invest in the company, buy shares and sell shares, and that money is of the company. तो पब्लिक का पैसा लगता है. Making sense?
Yes, ma'am.
Now they've taken a step further. What PEs and VCs do, they are also investors in your company, but they are more active investors. Now, for example, today I have, let's say, 1000 shares of Reliance. Okay. However, I am not going to go and run Reliance Industries.
Yes, ma'am.
But when a private equity or a venture capitalist buys a stake in your company, they also participate in your running affairs.
Ma'am, hi ma'am.
Yeah,
So this example you are taking, getting in the respect of like Z Entertainment, like Invesco has invested and they are also the active participants. The
correct,
same, yeah.
correct. So, for
Thanks.
example, when Kubota bought a stake in Escorts, they nominated two directors to the Escorts board of directors. We also want to know what you are doing. So, I have two representatives sitting in your board. That is what private equities and VCs also do. Private equities, however, don't do it much. They only invest in your company for a return. VCs are more active and they help you grow the business. The second difference is these are all early state entrants. You and I probably today may not invest in a company which is just starting up, just probably has developed just one prototype of a product. These people do because they assess growth and they want an excess return on their investment. So there are three types of investors. So there's an angel investor. He is someone who's given you initial money. मेरे पास कुछ नहीं था, मेरे पास सिर्फ एक प्रेजेंटेशन थी कि ये मेरा प्रोडक्ट है. He or she believed in me, gave me money to start the product. He or she is referred to as an angel investor. Now I have developed something, but I'm yet to test it out in the market. I'm not sure इसका क्या acceptance होगा. That is where a PE VC jumps in. They may also jump in later. कि हाँ, we have done a market validation of my product prototype. Now I want to produce at a mass scale and take it to the public offering. That's also where a PE VC can jump in. So they are nothing but investors into a company. Only difference being they are early investors. They are not like you and me who invest into companies when the product is absolutely validated, the product is flourishing, and the company has a history of profitability.
So, ma'am, these people invest even before the company goes public, right?
So much before. If a company is going public, that means the company has established its presence in the market and has a history of minimum 5 years of financial position, where they have given consistent profitability.
So, ma'am, through which platform do they invest?
Which platform I in?
As in, how do they know, like, where are these companies emerging and
If you are a startup enthusiast and you have a startup of your own and you need money, you go to these people with your idea. What is Shark Tank?
okay.
I have a platform. I am saying, okay, I am this high net worth individual. I have almost 2,000. Okay, I'm not gonna put a very egregious number. I hope I have it someday. I have $1 billion to invest. People will come to me. I don't need to go searching for people. People will come to me, make a pitch to me, tell me that I have this product. Tell us if this is interesting. You can be an investor into this company. Making sense?
Yeah.
And also what happens is when you have that sort of wealth and you move in those circles because that is your job profile, you hear of opportunities. You and I probably don't, but they do because that's their job. Their job is to find the next big thing in the market. So far, so good.
Ma'am, so companies like Paytm, which has no promoters, they're investors like SoftBank or what kind of investors are they? What will you call them?
So
They
they
are
are.
not VC.
So okay. Paytm becomes a different example because Paytm probably had the product much more validated before these people came in. But I would still consider them as private equity partners.
But they also have stakes like 19%, it's highest of SoftBank.
I'm
So
so
they
sorry.
won't.
Am I audible?
Yes, yes.
Yes.
Sorry, I think my system just snapped. It will take a couple of minutes. Meanwhile, so yeah, I didn't get the question in terms of how is the percentage of stake a significant decision maker? You can have any sort of stake in a company. Yeah, so no, I mean the conversation that we were having just before I logged out was there was this concern in terms of this person has a 19% stake in the company. So what different? I mean, where is this question coming from? Is what I want to kind of now solve for.
Ma'am, I was telling that if it will cross 20%, they would be called promoter if they actively participate in the operations of the company.
So there's a very fine line, okay, and these are also driven by your corporate law. So you have the New Companies Act of 2013, and there are certain thresholds of investment that you have in a company, and then you get tagged accordingly. For example, if you are someone who owns more than 26% in a company, you become a strategic investor because there are
Yeah,
not a lot
right.
of resolutions that a company can pass without your consent because they need a majority of 75% or more, and that doesn't happen until and unless you have your vote. Similarly, if you are someone who has more than 50%, you are someone who enjoys control in the company because nothing in the company can happen without your vote.
Yeah, you get the voting rights.
Correct. So you have these significant investor, strategic investor, controlling investor. But however, as a private equity or a venture capitalist, especially for private equity players, you are typically not looking at managing the company. All you are looking is to generate that delta return on your investment. You believe that this business is something that sounds wonderful. You want to have a part of it and hence you invest in it. आपको लगता है कि 10 साल में मेरा पैसा डबल हो जाएगा and hence you are investing.
हो ही गया वो लोग का.
हाँ हो ही रहा है, of course हो रहा है. I think I'm on back.
Thank you. And also, please understand, all of these private equity venture capitalist firms make big on one investment and lose out on 10. So you typically have these firms who are investing throughout. 10 of them don't work out and one suddenly clicks and they make money. Right? So there is no success guaranteed formula कि हाँ हम जो इन्वेस्टमेंट करेंगे वो ही हमेशा अच्छा करेगा.
As
But all
Warren
you
Buffett.
need is that one to turn up and do well for you. Sorry, I cut someone in the middle.
Yeah, ma'am. No, nothing, ma'am. It was just that, as Warren Buffett says, that it's not the frequency of success that is important; it's the magnitude of it.
Correct, correct. Great. So I think now I can move on.
Ma'am, I have one small doubt. What is meant by promoters?
So promoters are people who have initially started the company. They are the founders. For example, Anand Mahindra's family is a promoter in the Mahindra Group. Or Mukesh Ambani is a promoter of Reliance Industries.
Okay, ma'am.
Ma'am, one doubt regarding the venture capital investments. So suppose if we hear a news that Tiger Global has invested 50 million in a company that is valued at 500 million right now, are they actually pumping in 50 million into that startup in cash?
Yes, yes, absolutely.
Okay, thank you.
And 1500 on a 500 base is typically 3%. Right?
Yes, ma'am.
Yeah. So today, Tiger Global believes that this 15 mil that they are plugging into this company, let's say after 5 years, is going to give them 50 mil. So Tiger Global is not investing because it wants to run the company. It is investing because it believes that this company has 10x growth potential and will help them 10x their money.
Okay, ma'am. Got it.
That's it. And yes, they are definitely plugging in that amount of money. But the valuation, and I repeat, the valuation is just an estimate. The company neither has that sort of money, nor is it a guarantee that it will have that sort of money. But I believe that one day it was going to make big. So in a sense, the valuation absolutely is a fictitious number.
Ma'am, one question. Earlier you mentioned about companies while they're listing, they have to be profitable. But as we see in the last year,
that clause has been tweaked significantly. Now you need to have a history of operating. So you call it as operating history. So you need to have these 5 or 7 years of audited financial statements, which may or may not be profitable.
So, ma'am, you talked about promoters. So since
Yeah.
ITC as a company does not have any promoter holding in it, so how will they see their growth in that, since promoters' value is not in them? So
No, I didn't get the question. I'm sorry.
ITC does not have any promoters, right? So what will drive forward its growth, since the promoter does not have any stakes in it? The management is just working for the company. So what drives the growth in that company?
Why? The management will work for the growth of the company, right? Because they are answerable to the shareholder.
But promoter having a significant amount of equity will make the management team more accountable to them.
Not true. Not true. Why?
Okay. No, I think just
As
having
a
the
public shareholder, you can make management accountable.
Okay. No, I just thought having skin in the game, right, it makes it more accountable to them, the promoters.
Like ICICI Bank also doesn't have any promoter. SD, I guess. Yes Bank also doesn't have any promoters.
I absolutely disagree that you have to have a high promoter shareholding for the company to do well. All you need to have is a good product. Because if you are a company who has, let's say, 2 crore shareholders, you are answerable to each one of them irrespective of the quantum of shares held by each. Your performance pay packages are absolutely attributable to the performance of your company. Why, as a executive chairman, will I not want to do well?
Okay,
Right?
ma'am, got it. Hmm.
Yeah. Yeah.
Quick question, Janvi, please. Nikita here. So, what is the minimum percentage of stakes or uh, uh, percentage of share, I don't know, needed for a venture cap VC or a PE to be classified as a VC or a PE?
No percentage is defined.
Ma'am,
The
there
So,
was
how does
difference is
it work?
the difference is the interest in the management. If the VC is going to partner with you to get the product in place, get it to the market, he's a venture capitalist. If they are silent investors, they are private equities.
Okay. Okay, sure. Thank you.
Sure.
Ma'am, there was some discussion around promoters. So, ma'am, how do we know that a person is a promoter, and how do we know that there is a promoter for that particular company? I
So
mean,
you
I
you
don't
look
know.
at annual accounts of any company. There is something called a shareholding pattern that they have to present for each year as on the 31st March. And therein they mention these facts. They have to give you a list of who are the promoters, what they hold, who is a foreign institutional investor, who's a domestic institutional investor, what big individuals who own high percentage of shares of the company. They have to give you the entire detail.
This is available on the public domain for
Oh,
everyone.
yes. For all listed companies, you have to go to the company's website. There would be a tab typically which will be called Investor Relations. Go to Investor Relations. At the bottom, you'll find something like annual statements, financials. Go to that, download annual reports of these companies. Some of them will be bulky. Pick those up, go through them. You have to give everything there.
And then what goes on with those companies which are not listed? I mean, how do
For MCA filings, as I mentioned, please log into Ministry of Corporate Affairs. They have a tab called documents. I think you have to give 50 rupees or 75 rupees. Extract the latest annual statement that the company has filed with the registrar of companies. Access it.
Thank you, ma'am.
Every limited liability company has to file their annual returns either with the stock exchange and with the registrar of companies. However, if you're a listed company, because there are more regulations on you, as there is the investor money which sits with you, you have to have it freely available on your website. And if you are a shareholder of a company, you receive it by courier and post as well.
So, ma'am, I mean,
Uh,
suppose people who invest via these Zerodha and those online stockbrokers. So, do they also receive these kind of reports or?
If you are an if so today I am putting a disclaimer, not promoting the share, but I do own certain shares of ITC as an investor. Every year I get the annual report.
Ma'am, I mean,
Can I?
you mentioned that there are companies with no promoter. Hello,
Yeah, Kapil, go
am I
ahead.
audible? Yeah,
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 go
ma'am.
ahead.
I was saying that you mentioned that there are some companies like ITC who don't have any promoter holding, but a decrease in promoter holding is generally seen as a negative sign I mean, in the faith or the minds of investor, because I mean, a promoter leaving a company is, it signifies that something is not going correct with the company because he was the owner or the founder of the company per se. So, I mean, your
Two
views on
schools of
that?
thought. Kapil,
Just
two
yeah,
schools
no
of thought.
questions as much.
There is one thought which believes that The moment a promoter starts offloading its shares or his or her shares, it's seen as a sign of weakness that probably the company is not doing well or the promoter is looking for some sort of acquisition. So typically, it's a sign to say that, okay, there's going to be someone else coming in, and that kind of gets people jittery. However, the other school of thought is that a higher promoter shareholding inhibits growth from the public. Because the lesser the number of shares in the hands of the public, the lesser chances for growth. There are two schools of thought. You may ascribe to any.
It also hampers, I mean, high promoter holding also signifies hampered decision making.
These kind of shares are known as low float stocks.
Sorry. I think there are two people parallelly. It got a little difficult.
Kapil, go ahead.
Yeah, I mean, I was saying that, I mean, high promoter holding also hampers the decision making of the company. I mean, it said that because the promoter, I mean, since it just becomes a monopoly that he just has the funds from everyone, but he has his say in the company's decisions. Yeah. Thank you. Go ahead, Kumar. Yeah, sorry.
Excuse me, ma'am.
Yeah.
Hello. Am I audible? Ma'am, I wanted to ask, there are two school of thought you presented for this promoter offloading his or her shares. What was the second one? I didn't get it.
The second is that people do believe that if a promoter has a larger share, it's typically then a promoter-run company, and he or she may lack business acumen and soundness to allow the company to grow.
Okay.
And the other problem also is that because the promoter has a higher base of share, the shares available to the larger public are lesser. Hence, even if there's growth in the company, it's not in the hands of the public shareholder.
Okay, got it. Thank you.
All good? Can I go on?